I mean, did we peak this week on the VIX, Rod, or do we see 50 again next week?
Well, now, Vodi, we're having fun and we're playing the guessing game of what we've seen. Yeah, when the VIX gets up to these levels, I mean, volatility to me is like a rubber band. So when there's little volatility, a rubber band is literally lifeless. And then something comes along and really stretches it. And the one thing that I've learned in 35 years is when it gets really stretched, in order to return to its normal state, it's going to go like this. And you're going to watch incredible volatility and crazy swings, and you're going to be reporting on it. But the history of the VIX tells you that once you get into the 30-40 range, you're probably pretty close to the end. And as Abigail said, we're starting to come into some levels where long-term buyers, if they believe that this is not the end of the global cycle, that's us, are going to start to want to buy.
And where, Rod, are you looking to do that buying? Are you buying the U.S. market, for example, as a whole? Are you looking sector-specific, or are you looking outside of the U.S.?
You know, we haven't really kind of made our mind up. Our long-term positioning is to remain favorable in our balanced portfolios. It favors stocks, definitely is anti-bond. The one thing, the one asset class that has really changed for us in the last few years has been high yield. It used to be a big component of our balanced portfolios, and we're in the process of eliminating it. In terms of buying, I think that Japan and Asia, they are reacting actually quite well. The Nikkei looks like a good correction chart to me. And if this current phase allows the euro to stabilize and not strengthen too much, I think you'll have that coming back. So we favor the international markets, but we might start looking at the U.S. again for the first time in a while if we start to get this sort of looking at these levels.
Rod, Riverfront is the second largest ETF strategist in the industry. What lessons did you learn as an ETF strategist from, you know, the ETF blow-ups this week, and the ones that didn't blow up, maybe more specifically?
Well, I think we learned the lesson that we've been trying to preach forever, which is do not buy leveraged ETFs. They are not a good instrument. The ETF itself is a phenomenal instrument. It's well controlled, it's well understood, and the ones we expected to behave well behaved exactly the way we expected. But we have been warning people about the dangers of levered positive and levered inverse ETFs for a long time. So no surprise that, you know, people who were in that, had challenges.